So what is up, everybody? It is Joe here at budgetboss.ca. It is Wednesday, hump day, April 22nd. Hump day, what is hump day when you're at home in quarantine? Who knows? We don't know. Is it Wednesday? Is it Thursday? In fact, it's Wednesday, but it's the 22nd of April. It is Earth Day, so happy Earth Day. Earth Day is an important day to me because my favorite planet is planet Earth. Honestly, I haven't been to any other planet, so I'm a little bit biased, but planet Earth has got to be my favorite planet, and it's not even close. I can't even think of another planet that I like even half as much as planet Earth. So happy Earth Day. Make sure that you're actually staying home and taking care of the Earth by staying home and quarantining yourself and only going out if you need to go out. Let's make sure we can get back out and enjoy planet Earth. But one thing this quarantine has shown us is that by not going out and not emitting carbon gases, we are actually helping the Earth. Animals are roaming around the cities. They're reclaiming spots that they haven't seen in a long time. It's actually kind of cool to see what happens when we shut down the Earth for a little bit, besides all the other factors involved with it. That might be one of the only cool things that's going on right now. So happy Earth Day. Happy Wednesday. Today about mortgage free for life. This is a thought that people don't usually have when they talk about their mortgage or when they talk about buying a home. They don't think the goal of buying a home is to own the home. And this whole wave of train of thought has come out recently that keeping a mortgage and holding a mortgage and maintaining it for as long as possible is actually not a bad thing. This is an artificial thought that's come out recently because of artificially low interest rates. And that's the environment we've been in since the financial crisis of 2008. And that's the environment we're probably going to be in for a little while still because of the coronavirus. So what I want people to understand is that the goal to own a home is to actually own it and pay it off as quick as possible. And this is against the train of thought of a lot of people in my industry and in the financial services industry in general. Talk to people at the bank, they think owning a mortgage isn't a bad idea. Talk to many mortgage brokers, they think owning a mortgage and refinancing all the time is not a bad idea. This is where you have items like HELOCs that come out, home equity line of credit, where not paying off the principal is an okay thing to do. We need to get out of this mentality. And if you talk to the best and most smart and most savvy financial gurus, they will all tell you that the goal is paying off the home as quick as possible. So I'm going to go into my step 3 of the relevant retirement system, housing. Step 1 is budget. Step 2 is debt. Step 3 is housing. Even before insurance and investments in terms of getting to your retirement goals, you have to take care of housing. That's step 3 for a reason. It's more important than investing, and it's more important than insurance, and it's more important than any sort of opportunity you take advantage of. Paying off your home is super important, and I'm going to show you why today. And I'm going to show the contrary argument as well, why maybe not paying off your home and investing more is another way of going about it, and why that actually shouldn't be the way you go about it. First things first, though, let's jump into a market update. What do we see today? Positivity, green across the board. TSX up 273 points, and this is midday. It's around noon right now. We're looking at 412 for the Dow, 53, and 189 for the S&P 500 and NASDAQ in general. So all American indices are up. The Toronto Stock Exchange is up. Mind you, we had a negative day yesterday, a fairly negative day yesterday, and a negative day the day before on Monday. 2 negative days in a row. We're getting back some of those losses. Here's the situation we're in right now. Oil is very tumultuous right now. We need to make sure that we are not panicking based on cost of oil. And this is something we're going to be dealing with right now. Commodity-driven market fluctuations are usually temporary, and then the aftermath lasts a longer time. But right now, we're seeing large fluctuations on a daily basis due to the fact that oil is scarce. In terms of price, the price of a barrel of oil affects many different things in terms of the broader stock market. So what we've seen on Monday, first time in history, negative cost of oil. We've seen the May and June contracts since go up for future costs of oil. So basically, this is all speculation based on what they feel oil will cost in May and oil will cost in June. So people have actually bet on oil going up in June, but not recently. What they've done is bet on oil going down in June. and oil going down in May. And that's where you saw the negative prices for future contracts of oil. And basically what this means is we have too much oil and not enough people using it. And how is that happening? Of course, we're all inside. Case in point, I've only used a quarter tank of gas in 1 month. What does that tell you? We're not going anywhere. So we're not using up the oil. Planes are not using the oil. So what this is doing is causing the market to fluctuate based on the cost of a barrel of oil. What does this have to do with you? Nothing. Nothing at all. This is what we're seeing right now in the past 2 days. There's no panic because what's happening is the oil will sort itself out. Once the economy reopens, the cost of oil will go up, and then therefore it will actually help out the markets broadly. So we're seeing that the energy sector is taking a hit right now. We cannot panic based on that. So understand that these fluctuations are going to happen as the economy and the startup starts to sort itself out. All this is based on how we handle the virus. That is the number one thing. So continue doing what you're doing. Continue not panicking with market fluctuations. Again, a positive day today, does that mean it will go up continually? It does not. We are seeing day-to-day fluctuations, somewhat heavy ones, 1 or 2% on a day-to-day basis because of oil. So continue not panicking. Continue asking questions about your portfolio, adjust the allocation of it if you get the advice of an advisor. And if you want me to help you out with that, please let me know. I will take a look at your allocation and see if it's actually the way you want to be. So that is the markets right now. We're seeing positivity, but after 2 days of negativity. So do not panic. Do not freak out. Cost of oil has gone crazy. So let's not go crazy as well. So also, CERB, make sure that you're applying for the month-end CERB. This is the Canada Emergency Response Benefit. I have the link in all of the posts across all platforms. So make sure you're applying for this. You got to do it on a monthly basis, and you're also going to have a taxable burden next year when this comes out. So make sure you're planning for that as well. Today, also, Trudeau announced $9 billion to go to students in terms of funding. A lot of people who are students don't even make the $2,000. So, or if you graduated or are graduating, you're going to come out to an economy that may or may not have a job for you. So Trudeau's announced funding, $9 billion emergency student aid program. So this is huge. This is an important thing. They also announced that 70,000 summer jobs are going to be available for the government of Canada. And what this means to me is that there's probably going to be a lot of processing that needs to be done. So this is a good thing. They're hiring some people for the summer that maybe don't have jobs. So look out for that. Look out for the student benefits. I'm going to, as these come forward, I'm going to release them and tell you all about them. But look out if you're a student. Right now, this particular time is going to hit you a little bit hard because you may or may not be making up to that $2,000 anyway, or the part-time job you had reduced your hours, or you're getting out of university or college and now you don't even have a job prospect. Look out for those benefits. Look and see what you can do. And again, apply for the CERB right now for the month of May. And if you can, put a little bit away for tax as well. So, of course, I'm telling everyone about the Combo Expenses Worksheet. Make sure you download Combo Expenses Worksheet. Help you get your budget in order. Hundreds of people have downloaded it. It's a great resource that I've provided for free for you to get your budget in order. So let's jump into relevant retirement process step 3. This is my system on how to get to relevant retirement, and the first 5 steps are all about a relevant retirement. Step 6 and 7 are about a remarkable retirement, actually kicking it up a notch and becoming uber wealthy. Step 1 through 5, though, is how you can actually get to a retirement that will suit you, be comfortable, live the life you want to live in retirement. Step 1, budget. Step 2, debt. Step 3 is housing. Housing is very, very important. And what I want to talk today about is whether or not you should pay your mortgage down early. And step 3 is actually where I get into that. So for me, paying down your home early is vital to retiring relevantly. There's one thing that people don't understand about retirement is that oftentimes retirement chooses you and you don't choose retirement. So what you want to do is actually get to a point where you eliminate the largest monthly bill you have, and for most people, that is actually the mortgage. So paying off your house early is huge. There is no such thing as good debt. I do not care what anyone tells you. There is no such thing as good debt. There's only bad debt and worse debt. Worse debt being credit cards, lines of credit, unsecured debt. Bad debt, including student loans, mortgages, things of the such, right? You want to make sure that you're not getting yourself into worse debt, but Not many of us have a couple $100,000 lying around or $500,000 lying around, so we have to take out a mortgage to actually get the home that we need to live in. So although having a mortgage, people say, well, that's good debt. It's not good debt. You owe that payment every month. You still owe on it. It's only good when you own that asset. And the goal of owning a home should be to actually own it, not the bank owning it or the lender owning it. So in step 3 of the relevant retirement process, the relevant retirement system that I created, I talk about people wishing to retire early. And if you wish to retire early, the goal for you should be to pay off your home early. With my clients, I recommend to them not retiring until their home is paid off. The reason being is coming up with that monthly mortgage payment in retirement is very difficult to do, especially since your income has gone down. You oftentimes have a scarce amount of income or a limited amount of income, and putting a huge chunk of that towards a mortgage is going to definitely change your lifestyle in retirement. So majority of people feel like they should be able to retire early or want to retire early. Freedom 55 is the number people think of. I want to retire at age 55, 60. You can only get to that point if you eliminate the home payment. And that's the reason being is this. The house that you own is often the biggest asset that you have. That house is your transition piece to every house for the rest of your life. So for instance, your starter home that you buy, you're going to transition that into an upgraded home for the family. That family home may be another home later in life as the kids get older. When the kids move out, maybe you downsize and move that into a smaller place because you don't need such a large place. Eventually, you're going to need long-term care. That needs to be paid for. People think of your home as an asset or as an investment. It is not an investment. Your home is an asset. It's not an investment. Investments only get realized when they're sold. You will always have to live somewhere, though. You can't sell your home and live in a dumpster because you made a lot on your investment of a home. What you need to do is actually use your home as the transition piece to other forms of housing in your lifetime because of this huge asset. Now, this huge asset only becomes fully fulfilled when you actually pay it off. And that's what I want people to understand. The cost of long-term care is massive. You're going to need to come up with that money. Oftentimes it's $3,000, $4,000, $5,000 a month. You need a chunk of money to actually pay for that for the rest of your life unless you have long-term care insurance. So what you need to do is make sure that you're using your home as this housing asset to transition you through housing for the rest of your life. So why is housing so important in retirement? Housing is generally the largest expense for most people on a monthly basis. If you truly master your budget, relevant retirement step 1, and truly master debt, getting rid of that, relevant retirement step 2, you can see why housing plays a huge role in your everyday life. It's the biggest chunk. And if there's anything coronavirus has taught us is that people are very, very living on the edge in terms of their housing costs. You see people can't afford their mortgage unless their full amount of income is coming in. And this is why the banks are offering mortgage deferrals. So people are putting off their mortgage for 6 months because they can't afford to make the payment. So that just shows you how huge of a chunk of people's monthly budgets that housing actually is. So this is why my monthly budget worksheet is so important. Understand that. In my worksheet, I allocate 35% as the benchmark for your housing. And this actually includes your utilities, your hydro, your gas, your water bill, all that stuff, electricity. Make sure that you are not overly crossing the 35% threshold in terms of housing as your monthly budget. And that's your take-home pay, not your net, not your gross pay, your net pay. And that's a huge difference. A lot of people actually use their gross pay as the benchmark for their budget. You have to use your net pay. The money that you give the government is not your money, so I wouldn't consider that as part of your monthly budget. Taking a minimalist approach to budgeting is huge, and actually understanding your budget and how housing fits in. Cutting back those major fixed expenses, you can't not live somewhere. So getting rid of that cost is huge. Downgrading the utilities that you have and actually spending as little on them as possible. But the one thing you need to realize is that certain utilities and certain costs you're going to need for the rest of your life. You're always going to need hydro. You're always going to need internet. You're always going to need heating. Those costs, even when you're retired, are still going to be there. The one cost you can eliminate is the biggest one, your home mortgage in general. Not paying that $800, $1,000, $1,200, $1,500, $2,000 a month is massive. It's a massive way to save money in retirement, especially when you're trying to live on a limited income. There's so many benefits to home payoff, and I'm going to describe them in this post. The huge benefit is obviously the monthly savings. The goal is actually trying to get to a net worth millionaire. It's my goal for my clients to become a net worth millionaire, and a huge chunk of that is actually their mortgage or their home itself. The value of their home is pretty massive in terms of getting to that net worth millionaire status. That could be even half of it or even more than half of it. So I'm going to talk about that in a little bit. So the goal is actually owning your home. Two main hurdles to actually owning your home. The first hurdle is the flawed idea of your home and investment. Now, I talked about that. There's a lot of people talking about it's the best investment you can make. It's not an investment. First of all, if it is an investment, it's a very poor investment. I don't know any investments where I have to maintain a basis. I don't have to actually I don't have to pay property tax for my investments. I don't have to buy insurance for my investments. I don't have to actually go through the process of maintaining my investments for maintenance. That is a flawed idea. There's no investments that require that amount of upkeep over time. The other part of it is that in an economic sense, an investment is the purchase of goods that are not consumed today, are used in the future to create wealth. In finance, an investment is a monetary asset purchased with the idea that the asset will provide income in the future or a later date, sold at a higher price for a profit. Key points in that definition are that don't pertain to your home, is not consumed today, provide income at a later date, or sold at a higher price for profit. So your home must be sold to provide you with a profit. Your primary residence must be sold to provide you with income unless you use a portion of it and take a portion of it out, which is your home equity. Your home must not be consumed today, which you are doing. Your home is essentially, what it is a large piggy bank. It's a large bank account that you're contributing to every month. You got to look at it as a bank account, not an investment. Your savings account and your checking account, in my opinion, are not investments. Your investment vehicles are investments. Your home is a piggy bank. Your home is not an investment. So that's the way you got to look at it. You got to contribute to it on a monthly basis, knowing that you're going to actually reap the rewards of that later in life. And that's the part of it that people understand. And the reason why they're getting to that point right now where it's actually they think that it's an investment is because they've seen the value of their properties go up huge recently. So for instance, some people are buying homes 5 years ago for $300,000 and now they're worth $500,000. That may not happen again for another 25 years. That's what people need to understand. Now, it may happen, but it may not. You don't know that. So what we need to understand is that home values recently have gone up, but for a good 20 years, they didn't move at all. So although you've made money recently in terms of the home value going up, that is the market correcting itself from long ago where it didn't go up at all. So the piggy bank must be contributed to on a monthly basis, and that's you making your mortgage payment. The key word to that is must. The piggy bank must also be maintained and protected. The piggy bank is not guaranteed to go up in value. Think of the housing crisis in the mid-2000s, 2006 to 2008 housing crisis. It's not meant to scare you. It's meant more to open your eyes. There are people that overnight their home value declined in half in 2008. Half. Not saying that will happen again, but it might happen again. So that's a huge thing to understand. The next part is actually meant to scare you. There's a whole industry attempting to separate you from your piggy bank or your home. Lenders, real estate agents have realized the potential to generate profits. As mentioned in step 2 of the relevant retirement system, debt, keeping you in perpetual debt, is extremely profitable. Debt is actually one way that people make money, and lenders have actually realized that they can make more money off your debt than they can off your investments or your savings, and that's a huge thing. The prolonging of consumer debt repayment means you're making lenders very wealthy. By not paying off your home, you're also doing this. This is why attaching lines of credit to your home is so incredibly easy. If you own a home, you're probably getting a call from the bank all the time about attaching a line of credit to it or opening up a home line of credit. This is a massive, massive thing. It's a huge industry. This is why reverse mortgages and second mortgages and special home renovation lines of credit and a variety of other debt products are super popular. This is why the housing market has been on fire of lately. They call it a bubble. What happens when inflation drives up home values, the demand for the homes go up with the public, and that's what perpetuates the home values going up, and the demand goes up and the cost goes up. And that's the huge thing. Your piggy bank, which is your home, must be protected. And that includes from yourself drawing from this investment and actually prolonging the time to pay it back. Remember, every dollar that you owe for your home has interest attached to it. So you need to understand that. The way to fully protect your home and actually keep your home is to pay it off. You own it and no one can mess with it when that happens. And even if the value of it goes down, it doesn't matter because you own it. That's the huge part about it. If you own it and the value goes down and then you can't make your payment and you're forced to sell, then you're in big trouble. The value of your home doesn't matter. You're looking as a long-term asset. You're not looking as a short-term asset. Just like your RSP, your tax-free savings account, or any investments you have, if the value goes down because of, say, coronavirus, you're not worried about it because you know you're going to ride it out and it will go back up eventually. The same is true with the value of your home. You should not be overly concerned with the value of your home. The value of a home is only realized when you go to sell. And if your home is paid off, you can strategically sell your home when the value is profitable for you. But if the value is down and you have to sell because you can't afford to maintain, in that situation, you are in big, big trouble. So what I'm going to talk about next is the fallacy of home equity. So I add home equity as part of my client's net worth calculations. I'm also, the one thing about it, it is an asset. I will consider it an asset, but I will not consider it a liquidatable asset. That's what I want people to understand. It's not cash that you can grab from. I don't think cash that's trapped in houses or life insurance policies, stuff like that, that is not cash that you should access willy-nilly. That's the huge thing. What I will admit is that it's not meant to be thought of as something that you can go after or go get at any basis or for any reason. And the reason why I want people to understand that is because it's become so popular and so normal for people to access their home equity to, say, make renovations or to, say, actually pay off debts and something like that. Now, the lesser of multiple evils is actually paying off high interest debt with lower interest debt. But what you need to understand is that if you're refinancing to pay off high interest debt, you need to make a goal of yours is to pay off the home as quick as possible. So the goal, step 2 in the relevant retirement system, is get rid of your debt. Step 3 is pay off your home. If the goal to pay off the debt is used to pay off the home, that is all right as long as the math checks out. And that's a huge thing. So what you need to do is actually work through the calculations, understand the cost of your high interest debt versus the cost of your low interest debt, and use your home equity to pay off the high interest debt, and then focus with leopard mentality, gazelle strength, and get rid of the mortgages as quick as possible. So again, the big goal, get rid of the mortgage as quick as possible. Most people don't understand this, though. Most people are thinking of home equity as something that they can use and calculate as part of their investable assets, their cash assets. It's just not the case. Right now, especially, people are starting to understand that. Early home pay down as it relates to early retirement. Now, this is the nitty-gritty of the post. This is where the rubber meets the road. This is where it's important. I give an example, and one of my financial heroes, Chris Hogan of the Dave Ramsey family. An example he gives is, wouldn't you rather have mortgage size investment payments into your investment accounts rather than paying into a debt? Ultimately, every mortgage payment you make, a part of it is interest. Every investment payment you make, all of it is your investable assets. That is the key to it. So I would rather have a paid off home and to make investable assets as big as possible. So this is Chris Hogan. He actually wrote a book called Everyday Millionaires, and for that book inspired me to come up with my relevant retirement system. You're hampered on a monthly basis when it comes to actually investing when you have huge payments that come out. This obviously includes debt, and this obviously includes your mortgage. Dave Ramsey family advocates that you should put a 15-year mortgage as the maximum length. I have nothing against people using 25-year mortgages, but the goal of it should be to pay it down in 15 years or less. So making your monthly payment as small as possible that fits within your budget is fine as long as you have the mentality of actually doubling up payments and using the avenues that the mortgage lender provides you to pay it off as quick as possible. So I give an example. If you buy a home at the age of 30 years old and you pay it off in 15 years, you have fast-tracked your retirement. That means you are mortgage-free at the age of 45. A $3,000 or $300,000 home with an interest rate of 3% will cost you roughly $1,400 a month. $1,420 a month will be your mortgage payment on a $300,000 home with a 3% interest rate. We cannot predict the future rate, so I'm going to assume that it will stay 3% over the length of your amortization. We all know that's not going to happen, but let's just say it's going to be 3% because for example purposes, we need to do that. This is a standard 25-year mortgage. During this time, you also contribute $300 monthly to your retirement savings account. At the end of your 25-year mortgage, so you're paying it out in the normal 25-year amortization, you'll have paid off your home by the age of 55 instead of 45 like I recommend. You'll also have a very nice $272,000 roughly in your retirement savings account, assuming that we get a rate of return of 8% during those years. So you've paid off your mortgage and you have $272,000 in your retirement account over the course of 25 years and you're 55 years old. So we all could probably agree that $272,000 is not enough to retire on, especially these days. So let's go over another example. This is my 15-year example. So in this example, you still buy the $300,000 home at the age of 30. You still have the payment of $1,420 a month. Then you still squirrel away $300 a month to put into your retirement account. Instead, the big difference with this one is you put an extra $6,000 a year into your mortgage, which equates to $500 a month. $500 extra dollars a month, $6,000 to put into your mortgage. Your house will now be paid off in 16 years and 3 months. Your retirement account is going to be less, obviously, because you only have had 15 years of compounding interest and accumulation, so you only have $113,000 because it has been 15 years. For the next 9 years of this equation, you put mortgage-sized payments into your account because now you don't have a mortgage. So now you're putting $20,000 or $1,700 a month into your retirement savings account. $300 beforehand and $1,400 from the lack of your mortgage payments. Now by the age of 55, you have a paid off home, just like the other example, and you have $490,000 in your retirement accounts. That's an increase of $200,000 in savings in your retirement accounts at the age of 55 because instead you've worked on paying off your mortgage quicker and using those assets for 9 years after you've paid it off to put into your retirement accounts. That's also 9 years of mortgage freedom, 9 years of flexibility, and 9 years of peace of mind knowing that you've had your mortgage paid off since the age of 45, 46 roughly. So if your home value increased over those 25 years from the age 30 to 55, 3%, which is roughly the amount home values have increased over time, your home would be worth, instead of $300,000, it would be worth $634,000 from your original $300,000 purchase price. This is added to your investment account values, which are an astounding 1.2 or 1.124 million. Congratulations, you are a net worth millionaire. So your $634,000 worth of home value plus your $490,000 in retirement accounts, you now have a net worth of 1.1 million. And this is at the age of 45 with no mortgage payment and a retirement account of almost $500,000. So I see a couple arguments in this position. One of the arguments that develops is on my stance is that people say, well, you can just invest the excess mortgage money that you're paying every month, say that's $6,000 you're paying every year into your mortgage, and you can get a better rate of return on your mortgage or on your investment than your mortgage value is worth. So 25 years of investing, $800 a month, that's $300 plus the other $500 that you were putting towards your mortgage, you're going to have $727,000 a month. In the above example, your home value has grown over to $634,000. So here's the big differentiating factor. So by investing your money, you're going to have 1.3 million, and when you don't invest your money and you pay off your home early, you have 1.1 million. So here's where people argue the other side of it. $237,000 more will be your net worth if you invest instead of paying your mortgage off early. I'm going to show you why this is faulty. So this is based on several assumptions. So again, I'll recap. Instead of paying off your mortgage early, you take the extra money where you would have paid it off early and invest it and continue to pay the bare minimum on your mortgage over the course of that time. So here's the assumptions and why this is faulty and why paying off your home is the better option. It assumes that interest rates will remain low. So right now, while they're low, they will not stay that way forever. That's a fact. They will go up. They'll go down, they'll go up. They'll go down, they'll go up. We all know that. That's going to happen. So even a 1% change in interest rates affects how much of a profit you make in this situation. So for instance, if it goes up to 4%, you're only going to make $189,000 or $189,000 in profit as opposed to paying off your home early. If it goes up to 5%, $169,000. It goes up to 6%, $147,000. So this is all based on interest rates. So interest rates are not a given. It's an assumption that we don't know. So we need to understand that. Also, investment returns, assuming you get 8%. If you're a conservative or balanced investor, getting 8% is often out of the question. As a balanced investor, you might be looking at 4, 5, 6%. As a conservative investor, 2 or 3%. So this is assuming that you're getting an advanced rate of return of 8%. As an advanced investor, you might make more than that, but if you're a balanced investor, maybe you don't like market swings and you don't get 8%. Here's the other thing, and here's the most important factor. This assumes as well that you're not going to have any life-altering events that take place during this time period. Again, a paid-off home helps with peace of mind, and scaling back investing contributions is far easier than pausing on your base mortgage payment. You owe that mortgage payment every month. You don't owe an investment payment every month. You can pause that if life gets in the way. Your elimination of your mortgage is a forced payment. At that point, you have no more payments other than your monthly bills. So you need to understand that when times get tough, as we understand right now, times are tough for a lot of people, not having that mortgage payment is huge. Imagine you didn't have a mortgage payment and you had only that $2,000 coming in from the government right now, and your bills per month were, say, $1,000. You could comfortably live off that other $1,000 just buying food. That is the big difference. It's the mortgage payment that costs $1,400 or so a month, or $1,200 or $1,000, or oftentimes $2,000 a month. That makes it very difficult to survive in times like this. And that peace of mind, to me, is worth far more than the little bit extra you'd get by investing as opposed to paying down your mortgage. Life has a lot of unknowns, dramatic unknowns. Coronavirus. Did we think in January that any of this would happen? No, we didn't. This is a huge unknown. So when things are unknown, and there's a lot of unknowns in life, and this can just be your individual health or your individual job status or your family's health or the economy, things you cannot control. So when things have all these unknowns, what you want to do is get back to the basics. And one of the basics and the fundamentals, and that's why my relevant retirement system is as basic as it gets, is paying off your home. My clients with mortgage payments always feel the weight of that payment. It bothers them. It's an albatross. It weighs on them. It's a control thing. And I like to think that the earlier you can take control of your financial future, the better. So the next question is, how do we get the mortgage? How do we get the money to even pay off the mortgage early? And there's several ways you can do that. It comes up all the time, but yes, you can do accelerated payments. You can do that lump sum payment, scaling back the budget, and that's why budget is a huge one. Car payments. I know people are paying $800 a month towards car. Imagine you're only paying $200 and putting the other $600 towards your mortgage. Or even better, 0 car payments because you saved up for your car. Imagine that. There's all sorts of ways you can find ways to make money every month. If you cannot go through your budget every month and find $600 a month, I reckon that you don't make enough money. You either spend too much or don't make enough, and I would reckon that it's probably a combination of the two. That's a huge, huge thing. If you have two people living under one household and the combination of the two of you can't find $75 a week to cut, $75 a week is the combination of the two of you, and that will equal an extra $600 a month, I reckon that you can do that. I reckon that you can do that. Guaranteed. And if this means brown bagging lunch for 15 years, why not? Why not? Because you can pay off your home early and reach financial freedom early. That is a huge, huge thing. There's going to have to be sacrifice. But if you want to retire at the age of 5, that is an abnormal goal. So why not take abnormal steps to achieving an abnormal goal? That to me is massive. And a lot of people don't think about it. In this post, I share a post from Canada Living, 5 ways to pay off your mortgage early. If you type in how to pay off your mortgage early into Google, there's thousands of articles on how to do it. The conclusion from my relevant retirement system, step 3, why you should pay off your mortgage early. It's about peace of mind. It's the mentality you have that actually you're taking the steps to put away debts and put money into yourself. By paying off your mortgage early, you're adding to an asset that grows over time. If you keep taking from it and delaying this payment, you're going to actually delay your retirement. Most people can't afford a $1,500 mortgage payment in retirement. The way of the before, where people would get defined benefit pensions, and that used to happen all the time, it's not happening anymore. There is no guaranteed income in retirement other than government or your own money. That is huge, and the government doesn't give you much. The defined benefit pension, they're few and far between. If you have one, bravo, I'm happy for you, but they don't exist. So what you need to do is get your payments in retirement, get your expenses in retirement down very, very small. That's a huge, huge thing. So I'm going to jump into this quick article here from Money Under 30, and I already talked about the arguments to pay it off, so I'll talk about the arguments to not pay it off. Yes, pay off your mortgage early. No. Your home will be disproportionately percentage of your net worth. By paying off your mortgage early, it's likely that a large amount of your net worth will be tied up in this home. This comes with its own risks. Real estate is often a safer investment than stocks, but it's not without risk. That is true. But the one thing about it, you will have to live somewhere. So you might as well live in somewhere that costs you nothing, as opposed to something that costs you other money, such as rent. And we all talk about owning versus renting. But if we're owning versus renting and we're not truly owning, then how is owning better than renting? People always chirp people who rent, oh, you're just paying someone else's mortgage. But are people who are paying their mortgage always paying their mortgage? Oftentimes, they're making the bank rich and they're delaying that gratification of paying off the mortgage. So here's the huge thing. You won't be able to realize the benefits of more extra mortgage payments for many years. That's one of the arguments. My retort to this, so what? It's supposed to be a long-term asset. You don't buy a home with the goal of selling it in a month and making money unless you're a flipper. And if you're a house flipper, then good luck to you. It's a very difficult thing to do. And let's just put it this way. I know guys that do it. They earn their money. They work hard, and it comes with its own risks. Other than that, your home is a long-term asset. That is something that you need to get into your head. You're not going to realize it for a long time? Fine. Good. So here's another one. If you lose your job, you could be screwed. You would have to borrow against it or sell it. Yes, but if it's paid off, then you can borrow against it. If it's paid off and you have emergency savings, you can use your emergency savings and still not have to pay off your mortgage every month if it's already paid off. That is a faulty argument. So you could be screwed. I don't buy that if you lose your job. Mortgage interest is tax deductible. The interest you get, the tax deduction you get from the interest you pay is minuscule. It's minuscule every year. $1,000 a year in tax deductible interest, who cares? The peace of mind by paying your mortgage off earlier rather than later is worth that amount of money. And the last one is when people talk about how your investable assets can grow higher versus your mortgage rate being lower. In my opinion, that is faulty as well. We talk about how the markets are insecure. While the markets go up and down, people are making bad decisions in terms of the markets, and they're making bad decisions in terms of their home. We need to understand that good decisions need to be made. Put our assets in investments, let them grow over time. I talked to that about investments being a long-term game. So is your home. You want to pay off your home and make that a long-term asset. You want to invest your money and make it a long-term investment. If you're playing the short game, i.e. right now, selling at bad times with your investments or your home, borrowing against your home on a consistent basis, you're not actually producing wealth. You're shifting too much, you're moving too much, and it's like a bar of soap. The more you touch it, the smaller it gets. That's a huge, huge thing that people need to understand. And that's why the gurus agree with me why you should pay your home off as soon as possible. And huge, huge point. Do not borrow against your home equity to invest money. This is called leveraging. I will never, ever, ever, ever recommend this to my clients, to borrow against their home equity to invest. That to me is a silly, silly idea, because worst comes to worst, no matter what happens, you have a home to live in. Worst comes to worst, if your investments go down, oh well, they will go back up if you give it some time. But if you don't have a home to live in, you're screwed. That is the huge factor. So I'm also going to include in this post today 7 ways to pay off your mortgage early. And this is from my boy, Dave Ramsey. He gives 7 keys, 7 steps to show you to pay off your home early. A noble goal, a great goal. I think you should check that out. So before we take off, again, apply for the government benefit CERB. Do it for the month of May. Put some money aside for your taxes if you can, and make sure that you're applying on a regular basis every month while this 4-month window is open. I have a strange feeling that this window for the $2,000 a month is going to be open longer than the 4 months, because I have a feeling we're going to have the economic results from this for a long, long time. Okay? Just a sip of coffee before I jump into a final market update. Our indices are still doing well. We're looking at 1 to 2% gains right now, so that is good. We're getting back the losses from the last 2 days, but again, we're only making moves for our investments when we're talking to an advisor. We're actually getting our plan in place, and now's a great time to address that, because chances are we have the time, and chances are your advisor wants to talk to you because they have the time to actually meet up with you. As they are working at home, like I am working at home. And if you do have questions about your investment mix or how you can take advantage of down markets by scaling up your aggressiveness in your investments, please let me know. I'm more than willing to review your investment mix at this period. So you can reach me at budgetboss.ca. That's the website. And you can also check me out, Facebook. At Joe Budget Boss is the Facebook page. Over 12,000 followers. We're creeping up to 13,000 likes on Facebook. That is pretty awesome. I'm on Twitter as well, so you can catch me on Twitter at Joe Budget Boss. Same with IG and IGTV. Every video will be on IG at Joe Budget Boss on Twitter, and my following on Twitter is growing all the time. And you can see professional Joe not wearing a boss t-shirt, wearing a suit and tie on LinkedIn. So Joseph James Francis on LinkedIn is my handle there, and I have over 6,000 connections on LinkedIn. I'm putting content on there all the time, so if you want to see me in a tie, put me there. Also, every video is going to be on YouTube, so I have the link to my YouTube library in the bio here, in the post here, so you can check that out. Also, contact me, sign up for the email list. Thousands of people are on my email list, so you can sign up on my website, budgetboss.ca/content or contact. budgetboss.ca/contact, and you could scroll down and book a meeting with me via phone or Zoom or Microsoft Teams, because that's the world we're living in right now. No face-to-face. That's what we're doing. So again, check that out, and check out Relevant Retirement System Step 3, all about housing. I want you guys to have a great day. Make sure you maintain the social distancing, because I want my summer. So don't be crazy like everyone down in the States protesting. We're getting through this. We're making it happen. Do what you got to do. Go for a run. Go for a jog. But maintain the distancing. Let's stop the curve. Let's make sure we're continuing on with this. And think of people that need help. Think of the local food bank. Local food bank's going to be needing donations all the time. So I want people to understand, yes, take care of yourself. But if you can, take care of others as well. So have yourself a great Wednesday, guys.